So now we go back to our original theory. Right? So what do we say? First part, debit, disposal, and credit fixed asset. What do you mean by that? That is, when you are disposing your asset, the asset, cost of the asset, or the carrying value of the asset, not the carrying value actually, it's the cost of the asset because depreciation will be reversed separately. Cost of the asset has to go out of the books. So in this case, we have 650,000 as the cost, which needs to be removed from the books. So what is the double entry? You will debit to the disposal account and credit the cost account. Debit the disposal account and credit the machinery account. Then number two is, if you are removing the cost of the asset from the books with the disposal, because the asset is no more with the company, then what you need to do is, even the depreciation relating to the asset that you have accumulated so far has to go out. So what do you mean by that? Whatever the accumulated depreciation you have for this asset also needs to go out. So what is the amount? We will be having 480,000. 480,000. That is what we have. So debit depreciation, accumulated depreciation account 480,000, and credit the disposal account of 480,000. 480,000. And part 3 will be where you bring in the sale proceeds on the disposal. So sale proceeds is 160,000, which means I have debited cash for 160,000 and bring in the disposal proceeds of 160,000 to the disposal account. So cash 160. Okay, right. Let's look at the board now. So what I have marked in blue, I hope you can see that. What I have marked in blue is the 3 transactions relating to the disposal. One, reversal of the cost, where I credit here and debit here. That is the slide, the first transaction in the slide. Number 2, I will reverse the depreciation, debit accumulated depreciation, credit disposal account, 480,000. Third transaction, the disposal proceeds, which is debit cash 160,000, credit disposal account 160,000. So we are done with all. Just a small point that I mean to insist or whatever mention. Now in the exam question, sometimes what happens, they might give you the depreciation up to this point, that is December 18. So basically, what is this depreciation? For 2019 means that could be the current year depreciation of this asset. So you have to be mindful. If they have not considered the depreciation for the current year, you have to provide for that, and then only you can do the disposal. So we have come up with the disposal transactions. Now it's a matter of balancing the disposal account. So here 650 On this side, how much? 640. So 650 is higher. On this side, 640. Okay. So, sorry. $650. So we get a difference of 10,000 compared to both. So what is that 10,000? 10,000 comes onto this side. Now it becomes 650. So when you credit the disposal account here, now you are crediting here. What do you mean by that? You have to go and debit somewhere. Now what is that somewhere? That is your P&L. So if you are debiting to the P&L from the disposal account, means that is what? Disposal profit or loss?
Loss.
It's a loss. It's a loss. So basically what we understand is when the net book value, what is the net book value here? 650 minus 480. 650 minus 480 means how much? I'm just writing it here. The net book value is 650. Don't write this on the T accounts. Since I don't have space, I'm writing it here. 650 minus 480 means I have 170. So my net book value is actually 170. But my sale proceeds is only 160. So if I am getting lesser than my net book value, obviously I will end up having a loss. That is what you have to remember. Theoretically, if the sale proceeds are less than the net book value, you will end up in a loss. If your sale proceeds are higher than the net book value, then you will end up having a profit. Okay. So that's it. You can take down. And if you have any questions, please ask. So the remaining parts are part 3 and part 4. Part 3, you have to write 3 journals. Debit what, credit what. That is number 1. This is number 1. This is number 2. This is number 3. And finally, this is number 4. So you have to write 4 journals in the form of what I have showed you in the slide. Debit what, credit what. You have to name the accounts and put the amounts and give a brief description. Any questions? No questions. Fine. So I will leave the remaining 2 parts to you all. Okay. Right. So let's get on to the next part. So accounting for retirements and disposals is done. What is left is the impairment of asset value, right? So impairment loss is actually something that results from the deterioration in value of the asset. Okay, so in general, the businesses don't recognize impairment as a routine transaction, because we don't expect an impairment of an asset unless there are substantial decrease in values due to various reasons. Okay, so normally what happens is we depreciate the asset, so the value of the asset is declining according to the depreciation method that you have chosen. In addition to that, there are certain assets where you will subject them to the revaluation, and as a result, the value deterioration in value, if there is anything, it will get captured. But on top of that, if you have any decrease in value of the asset due to any other reason, say maybe there could be a natural disaster, okay, due to floods. Due to floods, there is an asset which has got damaged and the value of the asset has come down. You know that the value of the asset has come down, but still you can use it. So you have to then estimate what is the value of the asset that has come down, and you have to account for it as impairment loss. So what you will do, you will debit your P&L as impairment loss and credit the cost of the asset. Credit the cost of the asset. Okay, but in general we don't follow this practice because wherever there is a reduction in value, that will be taken care by the application of the revaluation model. Now you know the subsequent measurement methods are cost model and revaluation model. So if you apply the revaluation model, that will be taken care. But any other asset that is not subject to revaluation will be looked after by way of depreciation. Okay, so we don't have to go into detail into this and you can just make a note of what this impairment is. Okay, so let's now look at a question which came in 2016 September paper. Can you read this question for yourself? So they have purchased a machinery on 1112 with an initial cost of 100,000, which was sold on 30th June 2015 for rupees 70,000. Right? They say the depreciation policy of the bank is to charge full depreciation for the year of purchase and no depreciation for the year of sale. The annual depreciation charge for the machine is 10,000. The annual depreciation charge for the machine is 10,000. These are the basic information that have been given to you. So date of purchase is there, cost is there, date of disposal is there, and what price they have sold is there, depreciation policy is there, and the annual depreciation charge is also given. Now let's look at the questions. What is the carrying value of the machinery at the time of disposal?
Excuse me, sir.
Yeah.
So we can't see the question.
We can't?
See the question.
No, I think in your handout it will not be there. I'm just doing this question in the class. You can hear me properly, right? So again, I would request everybody to have the past papers with you, at least the question papers, okay? Because that is necessary. As and when we go on, I will be doing the questions. So it doesn't matter. You just have a look at this and note down the key information of the question, right? Date of purchase is 1112. Cost is 100,000, and it has been sold on 30th June 2015 for rupees 70,000. Policy of the company is to charge fully a depreciation in the year of purchase and no depreciation in the year of sale. And they also say the annual depreciation charge for the machine is 10,000. Okay, that is the basic information. Now let's go to the questions. They are asking what is the carrying value of the machinery? Carrying value of the machinery. Can you calculate quickly? Carrying value of the machinery at the time of disposal. Carrying value of the machinery at the time of disposal. So I want you to calculate it now. So what you can do is you can start with the timeline, because the timeline will give you a better understanding. Because as I told you, that is the best thing that you can do in the exam, just to make yourself understand better. So the company has purchased this asset on 1112 for how much? 100,000. Right? And they have disposed on 30th June 2015. Right? So disposal, purchase, and the selling price is 70,000. Right. So if you look at the question, look at the board. This is the information that I have. On 1st of January 2012, I have purchased for 100,000, and on 30th June 2015, I have disposed for 70,000. Okay, so in between, what would have happened? In between, there would be several financial years which have ended, and for those years, I would have depreciated. So basically, yeah, since this is on 1st of January, and let's assume that it is 31st December that they close the financial year, right? This is an assumption. December 12, December 13, December 14, and actually it has to be December 15, but we don't worry about it because in June this is getting disposed. Okay, so according to this, basically this is your year of purchase. So what do the policy say? Year of purchase, you need to depreciate full. So which means there is annual depreciation, annual depreciation, that is for the first year. Then this year also you have used in full, that is annual depreciation 2. Then this year also you have used in full, that is annual depreciation 3. And this year you don't need to depreciate. Why? The policy says there is no depreciation in the year of disposal. Whether you have used it for 6 months or 12 months, it doesn't matter. The company says, I don't depreciate in the year of disposal. In the year of disposal. So they want us to calculate the carrying value. So in order to calculate the carrying value, what we need to know? Annual depreciation should be calculated for 3 financial years. Now, can we calculate the annual depreciation? Can we calculate the annual depreciation? I'm not getting an answer. Can we calculate the annual depreciation? Anyone? We don't need to calculate the annual depreciation because the question you have been already given. You have been already given. Why? It says, look at the question. It says the annual depreciation charge for the machine is rupees 10,000. Very straightforward. So you don't have to worry about calculating depreciation on this machine because it has been already given. That's why they have not mentioned anything about the useful life, anything on the depreciation rate. Those are not required. Because why I require those if I am supposed to calculate the depreciation. But in this question, they have very specifically given what is the annual depreciation charge. Now, I am told that whoever the candidates set for the examination in that respective sitting have missed this particular part. So they have been worried and looking at what is the depreciation rate and what was the lifetime of the asset. They have been going on those lines. So it is very important you read the question line by line and take everything onto your answer book. So if you had taken down annual depreciation as 10,000, then that gives you an idea. Okay, so you have to be very careful in reading the question. If you think and go in the line saying that I don't have the lifetime of the asset, I don't have the residual value, I don't have the depreciation rate, then you will get stuck there. So here the annual depreciation is already given. So what do you need to do? First part, first we have to calculate the accumulated depreciation. Accumulated depreciation, that we need to calculate. Why? It is for 3 years. So basically 3 years means 10,000 into 3 years. That is rupees 30,000. 30,000. And now we can calculate the carrying value. What is the carrying value? Carrying value is cost minus accumulated depreciation to the date of disposal. So cost is 100,000 minus accumulated depreciation 30,000. As a result, carrying value is 70,000. What do you mean by carrying value? That is what your net book value is. Net book value is. Is that clear? Okay. So first part is done. You have 5 marks. Okay. What is part 2? Part 2 is they want you to prepare the ledger account on disposal of machinery. So they want you to draw up the T account. T account. So I have already shown you how you draw up the T account for this particular question. So can you start doing it? Ledger account means that is they are talking about the T account. So what do I do? Since they have gone with the dates, let's try to do it with the dates itself. Okay. So disposal of machinery account. Okay. The T account, I am going to go with the routine structure where you will have the amount, description, and the date. So I have shown you already the structure. Then again, date, description, and amount. Okay. So this is how the structure will be for the disposal of machinery account. So what is the first one? The cost. And you are depreciating it on the 30th of June. So all the transactions are going to happen as of 30th June. So on 30th June, what you will do? You will reverse the cost of the machinery. So cost of machinery, which is 100,000. Then again on 30th June, you have to reverse the accumulated depreciation. Accumulated depreciation, you know, that is 30,000. And part 3, you have done the disposal, so you have received cash. How much is the cash? You have received cash of 70,000. 70,000. This is what the T account means, the ledger account. Any questions? Any questions? Right? So ledger accounts are done. Then what is the next part? What is the profit or loss on disposal of the machinery? So they are asking the profit or loss on the disposal. So now we have to balance the account. Now please remember, in examination you can't use red pens, right? Don't use the red pen for any purpose. Just because I'm doing in the class, I'm using it. But in exams you can't use the red pen. So it has to be either blue or black that you can use, right? Or you can draw these lines and everything with the pencil, but not to use any other color other than blue and black. So balancing. So when you try to balance it, this side 100,000, this side is also 100,000. Now comes the question. What is your profit or loss? What is your profit or loss? Anyone? What is the profit or loss? So actually, there is no profit, no loss. There is no profit, no loss, because you don't have a balancing figure to put in both sides. Because this side is also 100, this side is also 100. So there is no balancing figure that you need to put in. As a result, this disposal doesn't have any profit or any loss. Any profit or any loss. Okay? So if we go back to the question, what is the profit or loss on disposal of the machinery? What you can say is, and the last part of the question is explain two methods of calculating depreciation, so that we have already learned. So what you can do is, we'll look at how to write the last part. So in examination, they have asked you the disposal profit or loss. So what we have to say is part 3, profit or loss on disposal. So how do you calculate it? How do you calculate it? Sale proceeds minus net book value. Sale proceeds minus net book value. So sale proceeds 70,000 minus net book value. What is net book value? Net book value is cost minus accumulated depreciation. Okay. So 70,000 here, 70,000 here, which means I have an answer which is 0. So here the point is that when it comes to 0, if the profit or loss is 0, we don't say 0. You have to put nil. Okay, you have to put saying nil. There is nothing called where the profit is 0 or loss is 0. We don't say like that. So as a result, you put it as nil. Okay. Right. And the last part was to write on some description on 2 depreciation methods, so that you can manage, because we have learned 5 methods, so any of the 2 you can. So I want to give you a small note where you can remember. So if the sales proceeds are greater than net book value, just remember this as a formula, you will have a profit. Okay. If the sale proceeds are more than the net book value, you will have a profit. If the sales proceeds are less than the net book value, you will have a loss. If the sales proceeds are equivalent to net book value, then no profit or no loss. So that is the scenario that we have here. Okay. So remember this. This is like a mantra. Sale proceeds greater than net book value means it's a profit. Sale proceeds less than net book value means it's a loss. If the sale proceeds are equal to net book value, then you will have no profit or no loss. Okay. So that's all on LKS 16, which is on property, plant and equipment. Have any questions, please ask. We are done with the standard. So we have taken about 2.5 weeks, but still it's worth because you need to know this subject properly. There could be questions, adjustments, multiple choice questions. Anything that you want to clarify? Fine. So let's get into the next topic. Hope you have taken down this. Okay, we are going into a topic which is somewhat similar to what we did now. Okay. So like the LKS 16, there is another topic which is LKS 40. We call it as investment property. Investment property. So I hope the handouts have been already shared in the portal last week. So I hope you would have seen it. And let's get on with this topic. Okay. So let's start with this. Now we have already learned the property, plant and equipment. That is the PPE of a business. Now we have a question here where the property element of your fixed assets, the property element, which is the land or your building or part of your building, or it could be both. Okay. So some people might have only a land. Some people might have a land and building. Some people might have only a part of the building. There are scenarios like that. Okay. So depending on the purpose for which you hold, which we learn, it will vary between property, plant and equipment and investment property. Okay. If you can recall at the beginning of the standard LK 16, where we said LK 16 will apply wherever there is no other standard is applicable for this particular asset. Okay. So this is one such scenario where for certain fixed assets which are specifically on property, if LKS 40 is not going to come into the picture, then you will have LKS 16. But what we are looking at is whether there could be properties in a particular business whereby LKS 40 is applicable. Okay, that type of a test has to be done. But generally businesses know, depending on what is their business model and what they want to do, they can differentiate this between LKS 16 and LKS 40. Okay, so that is what we are going to look at. Now, you have property which is land or a building or part of the building or both. It could be both, right? Now, if this building is used for the purpose of production or supply of goods or services or for administrative purposes, then you obviously know it is what? It is property. It is fixed assets. Because as per the definition of fixed assets, this is what it said. As long as it is used in the production or supply of goods or services or for administrative purposes, means that is a PPE or LK 16 is applicable. Okay. Then there is another scenario where it is held for sale in the ordinary course of business. Now I spoke to you about this, where these land sellers, where they buy a plot of land and they divide it into pieces of small pieces of plot of land and they sell it. Now those are not part of the business. Those are held for sale. Held for sale means their intention is to make a profit out of selling these pieces of land. So those are like call these property sellers that you would have seen. They are into a different business and they are governed by a different standard also, which we will look at next week. Okay, so actually that standard is not in your scope, but I'll just give you a brief. That is a different standard, which is where the companies held or hold property for selling purposes. Now these condominium properties, what is their objective? They put up the building, there will be condominium units, they will sell each and every unit to people, public. Now that is their business. They are not going to use it in the production or supply of goods or services, or they are not going to use it for administrative purposes. Their business is construction of condominium units and sell them to public. So that's a different business. We call that as they are holding them for sale, held for sale in the ordinary course of business. So for that also, LKS 40 does not apply. LKS 40 does not apply. So now comes the question, then for what this LKS 40 applies? Okay, so that is what we are going to look at. Now look at the left side of it, where I have marked it as yes. Whether LK 40 applies? Yes, it applies when you have a property for these two purposes. What are the two purposes? One is if you are holding the property to earn rentals. To earn rentals. So what do you mean by that? You have a property in your books. You have put up a building. Say, well, let's take this building itself, IBSL property. Now this has about 10 floors. Now this is IBSL's own property. Okay. Now we have to see how many floors does IBSL occupy for its own use. Whether they are using in the production or supply of goods or services. Yes. What is their supply of services? That is education. Now, if they are providing education services, what are the floors of this building? They are using it for that purpose. There could be a library, there could be an administrative office, there could be a bookshop, there could be the cafeteria. So there could be so many floors, or maybe rooms that are being used by IBSL for its own business. But the moment IBSL decides to give it out on rent, certain floors or shops, or certain rooms in this building, that cannot be considered as part of PPE, or you can't apply LK 16 there. That is governed by a separate standard, which is known as LKAS 40. LKAS 40, which is the investment property standard. Investment property standard. Okay, so let me explain this concept on the board so that you will understand better. Right. Now let's look at this example so that it makes us very clear. Now let us assume a company, ABC company, has building A and building B. Very clear. Two buildings of this business. Now the question is, whether you apply LKS 16 for both these buildings. That is what my question is. Okay. Whether you can apply LKS 16 for both these buildings, building A and building B. I hope everybody can see the board. You can see the board. Right, fine. So now we are going to look into details. Now let's assume that building A is used to manufacture their products. To manufacture products. But with regard to this building, they are not going to use it in their business. They are not going to use it in their business. So they have now not decided what to do with this. But they have two options. They have two options. One is they can rent out this building. They can rent out this building. So they can find somebody who can occupy this building and earn a rental, monthly a rental, or maybe annually a rental. It doesn't matter. So you decide, I'm going to rent out this and earn rental. I'm not going to use it for my business. That is one option available to them. Then I'm going to put down some values also. Let's say this building is worth 10 million. This is on a location where the land prices and the building prices doesn't grow that much. It's in a place where it can be like 10 million. This is in a area where it is, let's say, the building is worth 15 million at the time of purchase, but every year the prices are going up. Prices are going up. Okay? Prices are going up. So if that is the case, then the company can hold this property to gain with the movement of prices. With the movement of prices. That we can call it as capital appreciation. Capital appreciation, because I have bought this building for 15 million, but day by day this price is going up because this building is located in an area where it is highly demanding. So people are desperate to find buildings. So you have a good opportunity where you can have a capital appreciation in this property. Okay. So building A is very clear, used in the business. Building B, we are left with two options. One is I am going to rent out, or I am going to hold it. I will just keep that building. I know day by day this price is going up. So when I come to a satisfactory level of a price, I will immediately sell it. I will immediately sell it. Okay. Now this is something very interesting. Whether you are going to rent out or whether you are going to use it for capital appreciation. But the moment you decide to use it for your manufacturing or business, then it's very straightforward that you need to apply LK 16. Okay. The moment you decide I'm going to use it to manufacture my products or do my business or for administrative purposes, I have to apply LK 16. But if I am looking at these two options, then I can't apply LK 16. I have to go with yes. Is this understood? Because this is very important. How do I differentiate between the application of LK 16 and LK 40 for property? You don't do it for computer, you don't do it for tables and chairs, for machinery. No, that is something different. This is applicable only for land and buildings. Land is also applicable, land or building. Okay, you can have a land or you can have a building. Let's put it to, I can call it as a building or a land, whatever, that doesn't matter. Okay, so my call here is whether I can apply LK 16 for both. For me to decide that, I need to look into details. What are the details? Whether am I using it to for the production of goods or services? Yes, I am here manufacturing good products. Then it's very clear that I need to apply LK 16. But here I'm not going to use it for my business. Now I have two options. I'm going to rent it out or I'm going to hold it for capital appreciation. So I have already explained what is capital appreciation is. Now the building was purchased at 15 million. Every year or maybe day by day the price is going up. 18 million, 19 million, 20 million, likewise it's going up. So that is capital appreciation because I have spent only 15 million, but by selling it, I can get 20-25 million. That's a capital appreciation. Or else, I can decide, no, I'm not going to look at selling this property because it's no point in selling it. I will rent it out for a higher price because there is a huge demand in this area for properties. So I can easily earn a good rental for a year by renting out this property. So the moment I decide one of the two, I don't have an option to apply LK 16. I can apply on LK 14. Is that understood? If so, you can take down. Please take down this. This will help you to understand. Okay. Sorry. Okay. Is that clear? Right. So let's go to the presentation. So some examples. Land held for long-term capital appreciation rather than for short-term sale in the ordinary course of business. So that is what I explained. I don't want to sell it in the short term, but I want to keep it for long term, where I can get an appreciation in value. Then second, a building owned by the reporting entity and leased out under an operating lease. So you can rent out the property and earn rentals. Now this is what mostly happening in the banks. Now if you look at every bank in Sri Lanka, mostly when they have large number of branches, not every bank has its own branch building. Only few of their branches are in own properties, but majority are on rented. So all branches, majority is on rented premises. Okay. So that is also one business. So people who have rented those properties, it's an investment property for them. Okay. Right. So let's look at this example. A company owns a piece of land. Now this is land. They are talking about the land. The directors have not yet decided whether to build a factory on it, or for use or in its business, or to keep it and sell it when its value has risen. Okay. So what do they mean by here is a company owns a piece of land. Now this is a land, right? They have not yet decided whether they want to put up a factory here there for their business, or to keep it, and when the prices go up, to sell it. Okay. Now the question is whether this could be classified as an investment property under LKS 40 or not. That is what you have to answer. Okay. So the answer is yes. Why? Under LKS 40, if an entity has not determined that it will use the land either as owner-occupied property or for short-term sale in the ordinary course of business, the land is considered as being held for capital appreciation. You see, the question clearly says the directors have not yet decided whether to build a factory for them to use or to keep it and sell it when value has risen. So that is like a short-term sale. No? So the company's directors have not yet decided means they don't have an idea. So which means they are going to keep it for a longer period for capital appreciation. For capital appreciation. So if it is for capital appreciation, then we know what is applicable is LKS 40. LKS 40. Okay. So in exams, if you are asked for a question like this is how you have to answer. First, you have to say whether it is yes or no, and then you have to give the reasons. Now, these are some examples where LKS 40 doesn't apply. LKS 40 doesn't apply, right? Okay. What are the examples? Property intended for sale in the ordinary course of business. I told you it is applicable under LKS 2 inventories. Then we have property being constructed or developed on behalf of third parties. Again, that is construction contracts. We don't consider it under LKS 40. Then the third one, which we have already learned, owner-occupied property. Owner-occupied property means it is for your own use. It is for your own use. Then the fourth item is where properties are used under finance leases. Those are covered by LKS 17. That is also a separate standard. Then the last one, which we already know, biological assets, which is covered by LKS 41. I told you the tea estates, rubber estates, all those are under LKS 41. Those also doesn't come under investment property. Definitions. So what do you mean by owner-occupied property? Owner-occupied property is property held by the owner for use in the production or supply of goods or services. That we know. Fair value, I don't need to go back again and explain, that we have already learned. Cost, you already know. Then carrying amount, you already know, because that's why I explained and took time and explained in detail under PPE. So what we have learned under PPE is not different here. It's the same thing. Fair value, cost, carrying amount, everything is same. Now, let's look at the recognition of investment property. So investment property should be recognized as an asset when two conditions are met. And by the way, these conditions you already know. It is probable that the future economic benefits that are associated with the investment property will flow to the entity. Secondly, the cost of the investment property can be measured reliably. So I think it is the same thing what we learned under LKS 16 also, right? When you should recognize a PPE, it is the same conditions that we had there. Initial measurement of investment property. So you know initial measurement should be at its cost, including the transaction costs. You know that. I explained in PP what are the initial costs and then what are the additional transaction costs involved in it. So a property interest held under a lease and classified as an investment property shall be accounted for it as it were a finance lease. So leasing standard covers separately this particular requirement. Then we go on to say the subsequent measurement of investment property. So how you measure subsequently an investment property. Now this is again the same thing that you have learned under LKS 16. What is called as the fair value model. And then the cost model. So under PPE also we had two models for subsequent measurement. What did we call those? What did we call those? The two models for subsequent measurement under PP. You had the revaluation model and the cost model. Okay. Now here, what is the difference? The difference is here we call it as the fair value model, and the other one is same as the cost model. Okay. So please remember, that is very important. Fine. So when you have an investment property, you need to provide all these details in your annual financial statements. If you are publishing your financial statements, you need to have all these details in your financial statements. What are those? Choice of fair value model or cost model. So what is the model that you are using for?
Excuse me, sir.
Yeah.
We can't see the slides.
Oh, this slide is not there?
It's on examples of investment property still.
Oh, hold on. How about now?
No. Now okay.
Right. Sorry about it. You should have told me earlier.
It's still on examples.
Oh, is it?
Now okay.
Now we can see
Yeah. Now okay.
this one.
Yeah.
Right. So we were on the last slide actually. This was the last slide. So disclosure requirements, what you have to give additionally to the reader. When you are preparing the annual financial statements, you need to provide them additional details if you have investment properties. So what are the details? Choice of fair value model or cost model. You have to say whether you are using the fair value model or the cost model. That you have to specifically mention. Then, whether property interest held as operating leases are included in the investment property. So which means whether you have taken any property for renting out purposes. If that is there, then you have to specifically mention that. Then criteria for classification as investment property. Now I explain you the criteria. Whether you have put this as investment property for capital appreciation or for rental purposes, that you have to mention. And then any assumptions that you have made in determining the fair value, use of independent professional valuers, because you have to go to a professional valuer and that valuer has to be certified by the Central Bank of Sri Lanka. So all those are there where you have to provide. Then if you have rented out this property, you have to show the rental income and related expenses. Then finally, you have to mention whether there are any restrictions or obligations on this property as well. Now, if you say that you can rent out this property only for 5 years due to some legal restriction, then you have to mention that. Okay, so it's very important that you need to provide these additional information. Okay, that is all about investment property, but I need to add a little bit onto this. Let's look at that also. Right. Okay, so you want slides 3 to 9 explained again. What's that? You can see the screen, right? So what I was talking about is whether the examples of investment property, whether you are holding it for long-term capital appreciation or it is a building owned by the reporting entity and leased out on an operating lease. Then we looked at this example where a company has a piece of land and the directors have not yet decided whether to put up a factory or to keep it for sale when the value goes up. So if the company is undecided on what to do, then it means that the company is holding this property for capital appreciation. Therefore, it can be considered under LKS 40. Then I also showed some exceptions where and where it is not an investment property. So as I told you, LKS 2, where the property is held for sale. The property sellers, where they divide a piece of land into several plots and they sell it. So that is covered under LKS 2. Then there could be instances where property is being constructed or developed on behalf of third parties. These contractors do what they do, they will be covered under construction costs, contracts. Then if it is owner occupied, that means you are occupying it for your own business, then it is LKS 16. If it is under a finance lease arrangement, you take it on lease, that will be covered under LKS 16. Then if it is a biological asset like tea estates, rubber estates, those are covered under LKS 41. Then here there were some definitions, okay, which is already done under PPE. I don't want to go into details again. Then when you recognize an investment property, so like the PPE, you can recognize it under two instances, where there it is probable that the future economic benefits associated with the property will flow to the entity. Then secondly, the cost of the entity, cost of the investment property can be measured reliably. Then initial measurement, as you know, it will be at cost plus any transaction costs. Then subsequent measurement is the one that we were dealing with, whether you to use the fair value model or the cost model. Fair value model or the cost model. Now, that is where I want to explain a little further. So let's look at that now. Okay, right. Now we have, now this confusion is done. So now we are clear with what is to be considered as investment property. Now let's look at the other aspect. Okay. So now we have an investment property. So now you have an investment property and you have two options. Whether to use the cost model or the fair value model. So what do you mean by that? I have purchased this property by paying 10 million. Okay. 10 million. So if I choose the cost model, the property will be still at 10 million. Every time it will be at 10 million. I don't go to change. Okay. But the moment I choose the fair value model, I have to do a fair valuation, or we call it as revaluation, every year, remember, where I need to get hold of a professional valuer certified by the Central Bank of Sri Lanka to value this property. Let's say in the very next year, the valuer gives you 12 million. 12 million. So now, when you go to the next financial year, the value of the property is not 10 million. Now it has to be shown at 12 million. So there is an increase in value. That is why we apply the fair value. So I don't want to take it at cost, showing every time it is 10 million, 10 million. Now I want to say that it is not 10 million. Now it has gone up by 2 million. So now it is 12 million. This is where the two options, cost model or fair value model. Right? I hope it is understood. Now what I wanted to emphasize is the differentiation between PPE and investment property. Okay, so that we will try to learn now or understand. So let's look at a company having a building which is classified as PPE, and the same company has another building or a property which is classified as investment property. Okay. Now here you know that you apply LKS 16. Here you apply LKS 40. LKS 40. Okay. Right. Now you have two options here, whether to go with the cost model or evaluation. Foreign exchange.
Chapter 7. Oh, okay, chapter 11. Right.
Yeah. 10, 11 kilo tin.
Chapter 11 in 10 11.
Right.
More popular
presentation
full mode gear full screen gear change
window करे
make a full screen battery जाता है बस output
present करा
लेकिन हमें मेरी गति है 3 लेकिन अपने गूगल का पता है
फिर मुझे right, so you have two options where PP can use the cost model or the revaluation model. Similarly, the investment property also, you can use the cost model or the fair value model, because these things you have to remember. It is very important. Okay, this is like a summary that I am doing. PPE, investment property, LKS 16, LKS 40, cost model, revaluation model, cost model, fair value model. So this we are not worried because that is already we know. Now, if you choose the revaluation model, what will you do with the revaluation gain or loss? I'm going with the same example. Let's say this property, let's say, right, two properties, same, let's say this is 10 million cost. This is 12 million. Okay. So you choose this to use revaluation model And when you did the revaluation, they say this is 15 million. So the value has gone up by 5 million. You do a fair valuation here for the investment property, the value has gone up to, let's say, 18 million. So value has gone up by 6 million. Okay. Now my question to you is, what will I do when there is an increase of 5 million here? And when I use the revaluation model, I have to account for this now. So what do you do? The accounting for this would be where the value has gone up by 5 million. So I have to account for it. What do I do? I will debit PPE or the building account by 5 million. And where will I credit? What is the credit? Where will you credit? Anyone? I explain this. You will credit it to revaluation reserve. Revaluation reserve, which is in the equity. Revaluation reserve. Okay, that is PP. Now, what is going to happen here? Somewhat similar, same thing, no difference. Now here the value of the property has gone up by 6 million. So here also, what do I need to do? The earlier the property was 12 million, now it is 18 million. So I have to increase the property value. So debit investment property million, and where will I credit? This is where the problem. This credit is very important. Now here you know this revaluation reserve is in equity. Okay, just like where you have capital, your retained earnings, your reserves. Now, under the investment property, when you use the fair value model, it goes into your fair value gain or loss. It goes into the fair value gain or loss, which is in your P&L. That is the biggest difference between the two. You have to make a special note about that. Here, the credit goes into credit or debit, whatever. It doesn't matter whether it is a gain or loss. It goes into the revaluation reserve, which is in equity. Here, it goes into fair value gain or loss, which is your P&L. So what I have considered is a situation where it is a gain. Here also it is a gain. Here also it is a gain. But there could be a situation where it could be a loss also. So this will get reversed. This will also get reversed. But theory is very important. When it is a PPE, if you are using the revaluation model, the resulting gain or loss will be recognized in the revaluation reserve, which is in equity. Okay. But under investment property, if you are using the fair value model, then the resulting gain or loss will be recognized in the fair value gain or loss account, which is in the P&L. Please make a note, because when we are doing questions, you need to know where this will be taken in the P&L format. When you are doing the statement of comprehensive income, you need to know where this item will appear. Because here we don't have an issue. This item will not appear in the P&L income statement of comprehensive income. It will be there, but not as a P&L item, because this is an equity item. So I want you to take down this. Very important. Please take down. Okay. Are we done? So that is the last point which I wanted to make under investment properties. Do you have any questions? If you have any questions, please raise. So you take a photograph, or maybe say you don't have a time to write. Okay. So let's get on with the next topic. That is the next handout. I think it is uploaded as week 10 or 11, one of the two. Okay. Right. Now we are going to look at 3 standards, which are very small standards, just for theory purposes that we are going to learn. And there will be questions on these also. So you need to know what these are. Okay. Right. So this will have 3 standards. But what I will do is, because of the best interest of the time, we will just cover. Let's see whether we can cover both. Only limited time is left. So there is LKS 21, there is LKS 8, and there is LKS 2. Okay. So in this handout, you have 3 standards. LKS 2, we will do it in the next class, because that I need to spend a little bit of time. Then let's start with LKS 8. That is slide number 7 of your handout. I hope everybody can see. Okay, right. Can we do it? So LKS 8 is about accounting policies, changes in accounting estimates and errors. So we know that what is now an accounting policy is. Accounting policy is the methodology, the assumptions, the bases that you use. So all those are put together. That is what called an accounting policy. And also you will relate it to an accounting standard also. Now say when you are applying LKS 16, you have to disclose an accounting policy. And this policy will have like whether you are using cost model or evaluation model, how you will recognize initially, how you will measure it subsequently, what are the depreciation rates, and what is your depreciation policy, like whether you depreciate in the year of purchase or in the year of disposal, full year. All those are put together mean that is an accounting policy. So what you can do is you can just go through, I don't know to what extent you will understand those. You can take a annual report of one of your own companies or maybe say some other company and go to the financial report section in that annual report. And there is one section which is talking about the accounting policies of the company. Just have a look at those and see, you will understand how they have written those policies and what are the things that are included there. Okay, so I don't know whether everybody will understand those, but better for you to just have a look at it. Okay, so when you go back, you can even look at through the web also. You can go to the Colombo Stock Exchange website, go to one of the companies that you would prefer and download the financials and go through it. It will have. Okay, looking at it in a PDF form will be much more convenient because you can do the search and everything there. Right. So what does this standard say? The objective of the standard is to prescribe the criteria for selecting and changing accounting policies, together with the accounting treatment and disclosure of changes in accounting policies, changes in accounting estimates, and corrections of errors. Now, what happens? Companies from one year to the another financial year, when they go, they do change their accounting policies according to the requirements of the company, or maybe what the accounting standard requires, or there could be instances where the application of the accounting standard may be wrong what they have applied, so they want to modify that. So all those changes are captured in this standard. So the objective of the standard is to prescribe the criteria for selecting and changing the accounting policies. How you do it? The standard is intended to enhance the relevance and reliability. So you know these terms, relevance and reliability, right? So of an entity's financial statements and the comparability. So now whatever that we learned, maybe the first chapter or the second chapter, are now coming into the picture. Relevance, reliability, comparability. So what does this accounting standards expect is to fulfill all these requirements. It should be relevant, it should be reliable, and it should be comparable. So these factors have to be captured in your financial statements over time and with other financial statements of other entity. Otherwise, what will happen? You may not be able to compare these financial statements with another company if you don't maintain relevance, reliability, and comparability. Accounting policies are the specific principles, bases, conventions, rules, and practices. So this also we already learned, where we said concepts, assumptions, principles. That is what we are talking about. A change in accounting estimate is an adjustment of the carrying amount of an asset or liability, or the amount of a periodic consumption of an asset. Now, this is where it relates to depreciation. Now, depreciation is one example. Okay. So what does it mean? A change in accounting estimate. A change in accounting estimate. Now, if you decide upon a depreciation rate, that is your accounting estimate. Why? I assume this asset could be depreciated over a period of 5 years. That is my accounting estimate. Now later on, I decide, no, I see now this asset cannot be depreciated for 5 years. I need to change it for 3 years. Now that is a change in accounting estimate. That is a change in accounting estimate. So where does it covered? It is covered under LKS 8. Okay. So when you are doing a change to your accounting estimate, it can have an impact in your financial statements in 2 ways. What are the 2 ways? It could be retrospectively or it could be prospectively. I told you this. I explained this what it is. If you are all of a sudden going and changing your depreciation rate, means you have to back calculate the depreciation and adjust it in your financial statements. But there could be instances where, like for example, the taxes. Certain taxes where you might have to adjust it prospectively, not retrospectively. Likewise, there could be changing of accounting estimates where you might want to do it prospectively. So what do you mean by change in accounting estimate and how it impacts the financial statements? You need to know, and how those are adjusted in financial statements. So changes in accounting estimate result from new information or new developments, and accordingly those are not corrections of errors. Correction of errors means where you have made a mistake and you rectify it. But changing an accounting estimate is not an error. It's a rectification of your assumption. So you have to be very careful. Somebody not posting a transaction, because we learned certain errors, you might remember. Now those are called errors. But if you decide to change your depreciation rate from 1 year to another year, that is not an error. That is a change in accounting estimate. Okay. So under the LKS 8, we talk about accounting policies. So I don't need to go into details, just go through the documents I told you. And what do you mean by change in accounting estimate? I have explained. And the errors we have already learned, because there were certain errors that we learned in a previous chapter. So go through them also as a revision process. Okay. So we'll stop there and we will continue next week on the 2 topics that are left here, which is LKS 21 and also LKS 02. Okay. Take care and have a pleasant weekend.